Hi, good morning, everyone. Let's wait till 8:05 for me to get started. Welcome to everybody who's come in for this. It's pronounced mermaid, so it's MRMD, which stands for Model Risk Management Discussion. Welcome. If you're watching this live, if you're watching this live on YouTube, that's great. Otherwise, you may be watching it at a future date. And know that all the shows, the first 11 and this, the 12th, are archived on that. I'll start right at 8:05, as I said. This, by the way, is, I would say, a minor Jewish holiday in the United States, but bigger in places like Israel. It's the fast of Tisha B'Av, sometimes called Tisha B'Av, which is a memorial to the destruction of the two ancient temples in Israel, of which one wall, so-called Western Wall, still stands. It's also called the Wailing Wall, not a whale like a whale in the ocean, but wailing like crying, because I guess when people saw that, they realized that so much of the temple was destroyed. In New York City, it means it's a day that they don't send the street sweepers around, the sweeping trucks. So it means you can park on the street, on that side of the street. Okay, it's 8:05, so why don't we get started? Um, I don't see anyone else on the Zoom right now. And if they don't come, then this will just be a lecture. Uh, Otherwise, please email me afterward or comments with questions. and you know how to reach me. So this is MRMD, also called Mermaid, number 12. And today we're going to review existing model risk management books. I'll explain what I mean by existing, and what the filter was to get that list. First, just for people who might be new to this or don't know the details, here's an introduction. So this Mermaid series is continuing. This is number 12, as we said, and it's every Tuesday at 8 a.m. Eastern Time, meaning New York. It's a series of lectures and discussions, and it supports our new textbook on MRM, Model Risk Management. That's Goldberg, Maheshwari, and Schachter. I'm Schachter. Academic Press will be publishing it in 2026, so we can call it GMS 2026. And the title is Model Risk Management, a textbook for financial engineers. So note that this is the first model risk management textbook ever. And these discussions are partly to give you updates on what's going on with the book and to foster a dialogue about topics we may have forgotten or topics that we could polish and so on. I'll talk a little bit about the updates on GMS 2026 in the next item 2. But for now, just so everyone knows, these mermaids are live streamed on YouTube. So this is live streaming right now, and that's where you may be watching it. And they're also archived there, every one. Also, there's a neat new thing that my co-author, Chandrakant Maheshwari, showed me, that you can take the minutes of the meeting automatically in AI. Zoom has a tool called AI Companion. And it's not 100%, it makes mistakes, but people also make mistakes when humans take minutes in meetings. All right, so here's a brief update on the book. We have now sent out several excerpts for peer review. One was just a table I'll refer to later. One was a lot of the introduction material, about 4 chapters, 60 pages. And then 1 chapter each on operational risk, on model risk governance, and on portfolio risk. The reason that we're doing this now is because we're going to start submitting to AP, to Academic Press, on December 1st. So we want to use the summer to get comments from people and not enter into that gray area once you give text to a publisher of who owns it and what can you do with it. In the last week, we added a new table with suggested chapters to emphasize for a 1-semester course. You may have seen that in other textbooks. Obviously, for 2 semesters, we would expect that all chapters in the book would be taught. And I'll have a list of those at the end. Let's say 1 a week. 1 a week. 1 every 2 weeks, 1 every 1.5 to 2 weeks over a semester. But you can imagine other cuts through it. Like, what if you only had 1 semester? Or what if you only had a risk management course that also had to carry information about risk management in interest rates, in credit, market risk, and so on. So some of the details of what we do this week. Already in the text, we had mentioned correlation, of course, and coefficient of variance. But the text now has some recent and some very recent additions, which bring in the reality that often a distribution, especially financial data, will have higher moments, such as skew, the 3rd moment, and kurtosis, the 4th moment. These are each central moments. So we began with the discussion and the statistics refresher to try to unify these themes. And one that's big emphasis for me is the standard error of measurement, the SEM, So new text this week presents the SEM for mean, for variance, for standard deviation, which is a little bit messy, for skew, and for kurtosis. So what that means is that now we can go back and give student exercises on some of the things we've said. An earlier chart in the text shows that correlation without skew, if it's Pearson correlation, sometimes called linear correlation because it's associated with linear regression. So Pearson correlation is not robust to higher moments. In other words, once you add skew and kurtosis, the correlation can be whatever it wants to be. It doesn't accurately reflect what it should do, which is, well, R squared should be the percentage of the model that can be explained by a regression line. The percentage, excuse me, of the relationship in the data can be explained by a linear model, meaning a linear regression line. In the case of coefficient of variance, which is simply, in its simplest form, is the standard deviation in units of the mean, sometimes in absolute value, that creates an interesting problem because it's a ratio of two quantities. Well, I've just told you a minute ago that there's standard error of measurement in both quantities. So that means that the relative errors of those two add in quadrature, and so that the coefficient of variance has an error bar, you can think of it as something like a plus or minus 2 standard deviations on its measurement, except that the standard deviation is now the SEM, the standard error of measurement. In other news, we finished the variance covariance VAR section. Variance covariance VAR is not widely used, but when it is, we want everyone to make sure they understand the trade-offs, the costs and the benefits, good and bad. And finally, as far as an update, we wrote a little bit about IV&V, which stands for independent validation and verification. It turns out that that was something that came by way of the Department of Defense in 1961, so during the Cold War. And to make a long story short, it was for the first computer models and the idea of adding some control to those. And then the independent part of it, which is essential also to things like SR 11.7, reflects that Department of Defense and proprietary banking models have something in common, which is that they need to be locked down. You can't have, a weapons lab can't allow certain data out and certain models out because you could build bombs with it. Similarly, a bank can't let its proprietary models out because they regard it, each of those models, as its secret sauce. So that would not be something you would want your competitors to get a hold of. All right, so today we're going to talk about where does GMS 2026 lie in the context of prior books since 2011. And we say 2011 because that's, of course, when the Fed guidance 2011-7 came out. So what we find generally, and I'll put up a PowerPoint in a minute that shows this in detail, is certainly that these prior books to ours make important contributions. But none is comprehensive. None is really a one-stop shop. If you wanted to have one book on your desk, it could not be one of these to do all MRM. And importantly, none is a textbook. Our book is the first textbook on model risk management, intended, as I presented in the title a minute ago, intended for financial engineering master's courses and for junior financial engineers in general coming into a project, let's say, who have not seen MRM or need a review of it. Finally, just to mention, we expect to describe a bit more regulation and its implications for MRM in future meetings. next Tuesday. At the moment, I've penciled in a discussion of the PRA's SS123. That's something that we talked about briefly in, I want to say in the first and maybe second MRMDs, but we haven't returned to it yet. So let me put up this PowerPoint and I guess do a slideshow. Get this bar just down here. Okay, and so the review is from 2011 to 2024, as we said, motivated by when regulators came out with their guidance. Indeed, 2011 was a renewal of interest in model risk management. It was not the beginning of it. For example, Karen Schneck had a big part in, I believe, in SR 2011-7, but she had done a lot of work before that at the New York Fed on model risk management in general. The difference was the great financial crisis and the Gaussian copula model, which I'll talk about a little bit later, showed really that mathematical models were a risk factor in ways that people didn't think about before. So here's a list. There's a lot of information in this table, as you can see, but just one second. So we ended up, there's some overlap in these books, and I apologize for not, I usually like sorted tables. I can't figure out what order this table is in, except that I think I just put the things in as I Googled things like model risk and model risk management on Amazon. And so I think the list is pretty complete. I'm certainly happy to entertain other books. So the first is the Marini book, Understanding and Managing Model Risk. So as you can see, none of these are textbooks. Some emphasize pricing models, some emphasize risk models, and some emphasize AI models, which I guess could be for pricing or for risk, but I've separated them as a separate category. So of the list of those 6 in the previous table, these 4 seem to be representative. And what I'm going to do is, for each book, I'll spend a few minutes saying what our understanding of the book is, a book review. That's at least something I think common to Americans. That's something that you do, I guess, starting in junior high school, maybe age 10 or something, that you go home and you read a book and then you summarize it for everybody. So this is just a summary. And so it's going to go backward in time and end with the Marini book. Okay, so the first of these is called Model Risk Management, Risk Bounds Under Uncertainty. And so the overview of this is that it's math. I mean, it reads something like, if you will, a geometry textbook with proofs and theorems and things like that. The focus is on a portfolio of assets and the metrics that could be calculated from that, and the models therefore are for value at risk, for expected tail loss, which they call tail VAR. Those would be the standard 2, and I'll go over the definitions later. They also consider what's called range VAR, which they give a reference for, and it basically is something to have the best of both worlds. There are trade-offs between VAR and expected tail loss. Ultimately, I think the summary is that this is a book best for academic, like PhD students and research faculty who want to really, think fundamentally about what it means to measure something. So just briefly, VAR is the risk at one particular quantile of a distribution. So for example, the 1-day risk of loss at 95% confidence. That means that at exactly 95% confidence, this is what you expect to lose. It's easy to calculate, but and it's easy to compare, but it doesn't necessarily tell you things like the tail loss. So one way to do that is to look in the tail. You could take the total loss in the tail, but it's been more the convention to take the average loss in the tail. So again, we could start with 95%, and we could integrate out the tail and take the mean of the loss above 95%, or whatever the floor is. The joke that I've heard is simply that VAR will tell you about the loss you will never have, because you assume you'll never get to 95% confidence. Excuse me. Rearrange something. Back hurts a little bit. Whereas ETL, expected tail loss, will tell you how much you lose. That should be how much loss you expect to lose if you do. VAR never happens. ETL is more realistic. Indeed, there's a further trade-off here that VAR can be back tested very easily. Let's say you look back for the last 250 trading days, which would represent a year, and you count, you just do binomial, was the day a loss or not, based on the desk data, which is clean P&L. So that's the actual about the bank made, removing things like, transactions costs and things, and aging of positions. And so the real P&L compared to that predicted by the model. So then on each of those 250 days, you can look and you can say, did VAR, 5% of those 250 days should have been losses if it's 95% confidence. So how many days did we actually lose? I'll go over this a little bit more when we talk about traffic light methodology. Expected tail loss can't be back tested because it's essentially an integral, so you can't really decouple the individual quantiles in there and talk about loss. But on the other hand, as we said, it gives a better sense of the total loss. And RVAR, which I mentioned earlier, is supposed to have advantages of both. Let's see. Right. The next book we're going to talk about is from 2021, and it's called Managing Model Risk. So this is mainly a qualitative treatment. So we move from a book with proofs and theorems to one which is mainly text, but it does communicate principles and philosophies of testing. It focuses only on AI models, which it describes as analytics models, meaning predictive and descriptive analytics. The two things that one can do with statistics is explain data that is in sample, and predict data that would be out of the sample. And it's good because it does talk about some topics that are specific to AI, such as risks in the actual data that's being used. You have this two-step process of training and then testing, and testing tests the prediction. We note in the book that this is not the maybe the most robust way to test models, and that using statistics, one can just focus on the training set and see how good a predictor it is, right? There's something called the PRESS statistic, which stands for the predicted residual sum of squares. And that's like the ordinary sum of squares, but it's a more marginal quantity in which each data point is removed one by one, and the fit is redone so that one can see which data points is the training set most sensitive to for when it calculates the model. One can also run them on a test set. It's just, different training sets and different test sets, and different percentage of the data split into training and test. I don't know, 70%, 30%, 50%, 50%. That's all going to give you different maybe errors, but also different results as far as what the actual model is. So I think, yeah, this is for policymakers, maybe model governance to try to figure out what the governance should be for something like AI. For example, here's the qualitative things. This, in this case, this is from Forbes, but this is, if we look at that first topic of data risk, there are a number of things, biases we know about, but there's other considerations, it's practical considerations that one cannot include over here, material non-public information like social security numbers. There are also paradigm shifts, so that essentially technology is non-stationary, and that would affect the interpretation of future uses of the model. Let's move on to the next book. So from 2016, we have a book that focuses on risk models and risk measures. So this is a little bit more like the discussion of the first book in 2024. But we'll get into the measures a little bit more, and not just for market risk, but we'll talk about credit and some other ones. Some of the important things in this, I think what you're seeing is that these books, since they're usually taught in a master's program, should interleave, basic risk concepts and other concepts. We'll talk about the kind of ways that volatility is calculated, so that model risk isn't necessarily something in and of itself, but takes into account, let's say, the partial differential equations that you're solving, and the Fokker-Planck and things, the other mathematical ways of thinking about finance in an integrated way. And in fact, I think this is a good book for junior FEs. So it's sort of close to what we're trying to achieve, and teaches them the statistics that they're often going to see, not just in model risk management, but in other analysis. So one of those things, some of you may know this, is the idea of a coherent risk manager. And that's something that is perhaps best explained by just considering a two asset portfolio, like two stocks, X and Y. So then define a risk measure, that could be VAR, it could be expected tail loss, it could be anything, and then look at two properties here and see whether that risk measure passes these. For example, the first line, subadditivity, says that the risk of holding both stocks is less than or equal to the risk of holding the first stock only, and the risk of holding the second stock only. So you can think about it as one trader holding both stocks with whatever diversification that provides, versus, let's say that's trader A, and trader B just has stock X, and trader C just has stock Y. So if you look at the combined risk held by the ones that hold the individual stocks in subadditivity, that measure should be it should be more. There should be a benefit to diversification, essentially. It also, risk needs to increase as the value of the asset, as the value of the loss in this case increases. So it turns out that VAR is actually not a coherent measure and does not always reward for diversity. And that's because, of course, it's the quantile of a distribution. And quantiles of distribution are not additive. They're just quantiles. The quantile of the joint distribution of X and Y at 95% is not the sum of the quantile of the 95% quantile of the X distribution plus the quantile of the Y distribution, right? The distributions don't literally add, they convolve. However, expected tail loss is a coherent measure, and one way to see that and the monotonicity property is, as I said, that it's a sum, it's an integral, and an integral is a linear operator. So certainly adding up the tail of one distribution plus the tail of another distribution is equivalent to adding up the tail losses of both in a single distribution. So in this case, expected tail loss does include the diversification effect. Another topic discussed in this SS 2016 book is specific statistics that you encounter first, I think, in finance because of these fat tails, this kurtosis, so-called leptokurticity in distributions. So, for example, if you want to tell whether two distributions are similar, and if they're relatively close to a normal distribution with low skew and low kurtosis, you ordinarily would use Kolmogorov-Smirnov, KS, which doesn't do any specific weighting on the tails. It just considers all the points equal. Kramer von Mies and Anderson-Darling have a weighting factor. You can think about it as 1 minus something in the denominator, so that the importance of the tails is going to get bigger as you get further out from the center of the distribution. So they're generally used in concert with, and are more accurate than KS, depending on how big the tails are. Finally, the first book after 2011 was by Marini, and it's indeed branded as a practical guide for quants, traders, and validators. So here you get the combination of pricing and risk models, but you don't get anything on AI models, because in 2011, AI was not a big deal. One nice thing about the book is there is a section about where hidden risk is, where you wouldn't think about it in a model. For example, the approximations that are used and the extrapolations. I think the best use of this book is that it emphasizes the methodologies that are likely to increase the risk of a model, and therefore should be the focus of the vetting of these models in model validation and model risk management. So what do I mean by that? Well, first of all, as noted earlier, the Gaussian copula model was very popular with CDOs, but also very likely was a reason for the great financial crisis. Instead of, everybody knows not to invest in the same asset, no single asset portfolios, but essentially Wall Street invested, almost all of its CDO quant work, let's say, was in the Gaussian copula model. I mean, the copula model itself is just a way to deal with a joint distribution. So in a CDO, you might have 100, 200 given credit names. Let's call them X1 to XN. And so each one of those has a cumulative density function, cumulative distribution function, excuse me, which we could call F. So no matter what the marginals are, we can introduce a correlation structure for those in the copula. The issue is how that correlation structure is specified, and as pointed out in this book, the simpler ones just didn't approximate anything. For one thing, at different points in the capital structure, meaning the parts of the CDO that are expect to higher or lower levels of losses, the correlation changes, so-called base correlation, in those tranches. So, those were poorly understood. And particularly, we talked a lot about correlation in the last couple of minutes, but we didn't mention the actual probability of default. So those things were a downfall of this model. Now, it's worth it to talk about equity volatility a little bit as well. And some of this can be applied also to FX. So in other words, we're dealing with the kind of instruments with maybe two or 3 month maturities. And for them, you're basically trading vol. And so in order to try to figure out things like price barrier options correctly using volatility. Well, post 1987, we found that volatility is not constant with strike, but can either be can either decrease with strike, or it can increase out of the money, decrease out of the money, but it doesn't have a certain behavior. It may be that it changes with delta. That's usually the way the strike is thought, or it may not. So the stickiness of the actual distributions motivated people to look at models so that you could price these more complex instruments. Barrier options I mentioned. Compound options is another one, which is, let's say what a call option is. So a compound option is a call on a call. So it gives you the right to buy or sell a call at some future date. So that's volatility sensitive as well. There are basically two approaches to model the volatility. One of them is to do it deterministically, and one of them is to do it stochastically. So the deterministic models, the most well-known is called local volatility, in which case let's see, my Zoom is blocking this a little bit. Okay. In which case the volatility sigma is a function of the stock price itself and time. So that's sort of reflecting something like the stickiness of volatility with the strike price. This is the stock price, not the strike price. I'm aware of that, but it tells you that as the stock price changes, you're moving to different parts of the volatility surface. Another model is the Heston model, which is preferred because there are closed form solutions for simple options, not for barrier options, but for simple ones like European options. The caveat is that those closed form solutions are Fourier transforms of prices and not the prices themselves, but it's still a nice model. The way that the stylistic aspects of having that skew in the volatility is done is to, we're all used to modeling stock prices as a deterministic component and a Wiener process, sometimes called a Brownian motion. So I'll say Brownian motion. In the Heston model, there are two Brownian motions and they're correlated. One of them is this original one, which was the stock price, and the other one is the volatility, okay, or variance. And so the volatility itself then has, so the reason that stocks are random is because there's a volatility, and that's what defines the amount of Brownian motion that's involved. Similarly, now in this case, we have to have volatility having its own volatility, sometimes called the vol of vol. So that means that, again, there's a deterministic part of it, of the volatility, and then there's a random part. And then those two are correlated. So it's essentially two coupled partial differential equations and a specification of correlation. The sign of the correlation can be used to match, the skew and volatility that we see. And in most cases, it's a positive correlation. Finally, there's a model called the SABRE model, which stands for stochastic alpha beta rho, which is essentially a model that can incorporate things like log normal and normal by a coefficient of the volatility process. So it could be the underlying S to a power, and depending on the power of that, you could get normal at one end, log normal at the other end, and then something in between. This was initially very popular. the modifications came when interest rates in Europe and other places, especially during the financial crisis, went negative. And then you had to have a so-called shifted Saber model, which means that a constant is added on to the underlying to force the sum of the constant plus the underlying rate to be greater than or equal to zero. What that constant should be, of course, is a matter of debate. And because we're looking at, interest rates that are stochastic to begin with. Anyway, so the nice thing in this book is that it compares the pricing of barriers with local volatility, the model at the top of the page, with these different stochastic volatility models to develop some intuition. So in the comments and in the and certainly reach out to me by messenger if you like. I wanted to try to, at this point in the talk, bring this around to our book. So this table is the current draft list of chapters in what I call GMS 2026, our forthcoming book on model risk management. So, for example, as I said earlier, all these topics would be included in a 2-semester course on model risk management. But then if we go to a 1-semester course, and especially on the basis of these books that we just looked at, what are the essential elements? So this is a draft, the last column here. As you can see, I included the first market risk chapter, which has to do with VAR and tail loss and things like that. But I didn't include the second one, which has to do with regulatory capital. Things like CCAR is also thought of as model risk. I didn't include credit risk. So that would be things like potential future exposure and margin requirements. So counterparty credit is what I mean by credit risk primarily. But I did include operational risk. And certainly in both cases, I included model governance. So, as I said, synthesizing what we said here and what we said going forward, I'd be interested in feedback on these. Okay, so that's the end of the formal discussion. Since there's no one directly on the Zoom, I may end this a little bit early. Let me take a sip of coffee and then just talk a little bit about what future meetings could have. So I'm working hard with a colleague in Mumbai who has experience both with the Fed standards, the Fed and the OCC, the US standards, and with the UK PRA, the Prudential Regulatory Authority. So, the same language in the US. The prudential regulators are the Fed, the OCC, the FDIC, and so on. So in that, we discovered some cultural things. I remember we did talk about this briefly, and there was a joke which was told, which was that you Americans have all these strict standards and things like SR 11.7, but in practice, the bank examiners don't really, enforce the letter of the law. They don't enforce it literally, and that's partly because it is too strict. So then they say, so we're English and we're practical. So our set of standards and our culture here is that you don't have to be super strict, that people have I don't know if it's a stiff upper lip or whatever the cultural thing is. People here know what is right and what is wrong in some sense. So they need guidelines more than rules. And the PRA evidently believes in this culture, and that a guideline, which is sort of a softer standard than a rule, is more likely to be followed. So that the compliance with their new document, which is called SS1/23, they would expect to be higher than the compliance with SR 11.7, the Fed document. I guess that remains to be seen. But in future talks, then we will discuss this. I may have enough to talk about it next Tuesday. I may have to go a little bit further. But the idea was to do something like a side-by-side comparison in a spreadsheet and say, for example, for third-party software, which is used in model risk management, what does the PRA say? What's the UK standard? What's the US standard by SR 11.7? Similarly, what's the role of audit and things like this? And I think this is important. And in fact, for the major financial regulators in the world, because if you're a global bank or if you're a consultant to global banks and different jurisdictions, then it's important to know these differences. I pointed out in a previous talk that Japan has something, but it's basically, so yeah, the transition then is, what about outside the UK and the US? Are there, strict or anyway, comprehensive model risk management standards? I think the short answer is no, not really. But some people have tried. Japan has maybe a 10 or 12-page document that is the greatest hits, if you will, the highlights of SR 11.7. But I don't know what role that plays. The Financial Services Authority, or FSA, of Japan does that. And I've yet to fully explore, but it seems like 3 other jurisdictions don't have all that much rigor, have to do it in more detail. But anyway, the other ones I'm considering are Canada, the Officer of the Superintendent of Financial Institutions, or OSFI. I think there must be something in Hong Kong, but I haven't seen it. Hong Kong Monetary Authority. I know Abu Dhabi has a standard. And then in the case of the rest of Europe, or if you say Europe meaning continental Europe, so then there's a couple things one could look at. One can look at BaFin, the German regulator, and they have a number of good regulatory documents in English, very accessible. But they and the European Central Bank are not that specific. They might write only about credit risk models. ECB has a long, or only about, the models that are developed internally, as opposed to including third-party models, data providers, and so on. So, I think I can definitely fill an hour talking about SS123. On the other ones, I certainly want to mention them. I should say, this idea of the spreadsheet comparing the UK and the US is something that we carry over into the book. And we want to be able to try to incorporate UAE and these other jurisdictions that I've said. But, it may be that that's impractical, and that it's more, maybe make some notes about what they would do, because these other institutions may not have the breadth, the comprehensiveness, the coverage that the UK and the US do. Okay, well, I think I'll give you back some of the time. We're about 10 minutes before the top of the hour here in New York City. So you can definitely watch this on playback. Usually within an hour or two, I post the minutes of this meeting. And I can also upload the PowerPoint that I showed. So I thank you all for your attention. Anyone can jump onto the Zoom if they want to ask questions at a future meeting. And I may reset up my MailChimp so that people actually register for this, and then I can more easily make sure that everybody has a reminder of when this starts. So thanks very much, everybody, and have a good, depending on what time zone you're in, have a good afternoon, evening, or morning. Bye-bye now.